Hello, everyone. Well, my name is Venkatesh Ramkumar, uh, but you can call me Venk Ramkumar, which is what all my associates call me, all my coworkers and all my friends and family, they call me Venk. The reason I want to start this video and create a video for you guys has been I have been researching financial asset classes, financial products, cash flowing products, hard assets, to general macroeconomics for the last 5 years or so. But I have really been getting into investing for the last 2 to 3 years. And I have been investing heavily, and I hope to one day start a company. But I want to create this video because I'm not trying to have it blow up into something huge or anything, but I want to document my progress through my investment journey and personal investment journey. If I do start a business, I want to document it, but I also want to share with you all my successes that I've had, my successes I have periodically. So today I'm going to give a little bit. It's going to be an introduction because I want to grow with you all, but I want you guys to also learn from me if you can. I think you can, but I also want to learn from you guys. So hopefully sometime in the future, if I get more viewers, they'll give me some feedback and they can give me some tips. But before I get into that, I do want to give you guys a quick background of me and show you my investments, show you my track record, and show you my investment strategy, which has been working well for me. I've been beating the markets now for the last 3 years or so, and I hope to continue beating the markets, and I believe I will. But I'm going to show you guys how. So I'm going to share my screen here. So here you guys are looking at a slideshow that I've created for you guys. Once again, my name is Venkatesh Ramkumar. You can call me Venk Ramkumar, Venk. So I just want to give a brief introduction about myself. I'm actually a biomedical engineer. That was my undergraduate education at the University of Delaware, graduated in 2019. So I'm 24 years old. I used to be an engineer in Delaware, but now I work as a financial analyst. I don't want to say exactly where, but it's not for a private company. So there's no before I give this, by the way, I just want to say this is not financial advice. This is merely me documenting my journey through the learning about finance that I want to share with you all. So please know that this is not financial advice. This is not, please do your own research. I always say, please use your own head, which is your biggest asset. But anyway, I now work as a financial analyst. Some of the people who I really look up to and I've been studying are Warren Buffett, Peter Lynch, and Benjamin Graham. All these guys are people who are value investors. They look at a company's cash flows in relation to historical valuations and future cash flows, future earnings, operating earnings, discounted cash flow analysis, and they basically create a model for their investments. I also like to read about Robert Kiyosaki, about the cash flow quadrant, how you have to buy assets that create cash flow and not assets that take money out of your pocket. So assets versus liabilities. And then Chuck Carnevale, you guys might not know, but I'll talk about how I incorporate some of his strategies. He does fast graphs, George Gammon, Mark Moss, and Peter Schiff. These guys do a lot of macroeconomics. So I've got a lot of inspiration from these guys. My whole thing is I like to understand how Austrian economics works in the current Keynesian world, along with doing the cash flow analysis and everything. So along with investing in cash flow assets, I understand right now how the banking system works, fractional reserve lending, and I understand the importance of hard assets. But I would say in terms of my investments right now, I'm only in the stock market, but I hope to also break into real estate within the next few years. I'm really focused on dividend growth value investing right now, which is buying companies that are producing strong dividends, but at the same time, those dividends have potential for growth. So you get a very high yield on cost. And I'm also trying to buy investments with a margin of safety, which means investments that are quote unquote unloved, but in relation to their cash flows, they are very, very cheap. So for example, earnings yields of 15% and plus. For example, if you want to know what an earnings yield is, it means if you're buying a stock for $100, the company is making $10 in earnings. Of those $10, they may pay out $5. That means that there's a payout ratio of 50% of the earnings. But the earnings yield is total earnings over total stock price, or how much you pay for the business. So if a company earns $10 and you pay $100 for the business, the business, if earnings don't grow, the business should pay itself back. It should pay you back in full in 10 years. So before I go into this, I just want to give you guys my portfolio versus the S&P 500 and the three indexes actually. So this is from March 2020. I was actually investing before this with Robinhood, but I kind of graduated it. And when I moved all my investments, so I had been investing for about a year before this. When I moved all my investments over after March 2020, when Robinhood had some issues, I moved it over to Merrill Edge. So I wasn't able to get the data from Robinhood, but I do have all the data from Merrill Edge. And really, this is where I really started to put a lot of money in. And when I mean a lot of money, that's relative. But as you can see, the total return, mine is 86.3% in the last 2.5 years. And the S&P 500 is 38.69%. Because this is total return, I've also looked at just the last year. Once again, the last year, because I'm in value investments, the S&P has been cratering because there's a lot of growth stocks, and I've been beating the S&P. I am now at 23% the last 1 year. So this is where I think my investment strategy really outshines because I look at investments cash flow. I like to buy into weakness on good companies. I'm not going to go through all the percentages, but obviously this is all talking about the same thing here. Of course, as you can see, the Dow Jones Industrial Average is sorry guys, I'm actually colorblind between red, green, and orange. So I think that's orange, but the Dow Jones on top, that's the 2.5 years since I started. Mine is 86.32, and there's the Dow Jones. And the bottom, this is for the last year. Obviously, I'm beating it again. And this is all from my brokerage, by the way. I didn't just make up these graphs. This is from Merrill Edge. Here's a NASDAQ total return. And once again, I'm beating them both. Of course, the NASDAQ is going down more because as inflation gets higher and the interest rates are going up, people want earnings now rather than later. So they're giving up on a lot of growth stocks are getting killed. So this is once again where my value investment is done very well. And as you can see, it's not that I've just started beating it. I mean, of course, the NASDAQ right now I've started beating it, but the S&P and the Dow, I was actually beating it on and off. I was tracking, except for lately I've just been destroying them. So I'm happy with that, and I hope to continue that. I actually want to show you my exact investments now. I'm not afraid of doing that, unlike a lot of the other people, because it's no skin off my back. I'm okay if people know what I'm invested in. I'm just not going to show you how many shares and the value and the cost basis and stuff where you can. I don't want to show you my net worth, stuff like that. So, but as you can see, I bought AbbVie at 100, and remember that this goes from highest, this goes from biggest position to smallest. So AbbVie, I bought at 100, it's now at 151. Lockheed Martin, my average cost basis is 361. I was buying at 330 as well. That's now gone up to 424, but actually I believe at the time of this recording, it's higher. Guys, this screenshot I took it about a week ago and made a presentation a week ago. So there may be some slight discrepancies today, but I'm pretty sure none of my stocks or companies have really tanked value. If anything, they've probably gone up. Amgen is a company that I've not really made the great gains in so far, but I believe this is a great value right now. So I'm actually continuing buying Amgen. Bristol Myers Squibb, Prudential, I'm up on all my top positions. Now, obviously, as you get lower into the positions, those are positions that I'm continuing to add in, and my positions are not as big because obviously the ones up top I've been holding for a while longer. So I don't mind having some losses, paper losses. Of course, I'm still getting dividends on all of these, but because I hope to be buying into more and more of these as the weeks and months go on. So I want to talk real quick before I get into a true example of an investment I made. I'm going to talk later in this presentation about Bristol Myers Squibb, how I made my buy at $59.95, which I'm now up 27% in. Um, Unlike a lot of other companies that have been, cratering lately, I'm actually up on this position heavily. And this doesn't also represent the dividends I've got. So I probably got another 4 or 5% of dividends. So in reality, my total return is about 32 or 33%. But I'm going to talk about that later. Why? But first, I'm going to talk about dividend growth and yield on cost. So what does dividend growth mean? Well, dividend growth is basically you want to look for companies that are growing their earnings very strong, very strong earnings growth year over year. So when these companies have earnings growth of 10, 15%, they can also increase their dividends at 10 or 15% year over year. You want to make sure these companies have a reasonable payout ratio and you're also paying a decent value for them. So that I'm going to get into that stuff later, but I'm going to give you a quick example here. If you buy a stock for that's paying $3 a share in dividends, it's $100 per share. Your dividend yield the first year is going to be you're going to get 3% of your money back in dividends per year. Now, let's say the company increases their dividends at 5% per year. Well, by 2030, you would be getting $4.80 for your $100 initial cost. So even though you only put in 100, you're now getting 4.8% back. 5% is actually very, very conservative. A lot of companies have been increasing their dividends for 10, 15, 20% every single year for the last 50 years. There's something called dividend aristocrats that have been increasing their dividends for 20 years, 25 years. There's also something called dividend king, which has been increasing their dividends for 50 years plus. So 5% is pretty conservative, but I mean, of course, anything can happen going forward. We could have economic recession, we could have a depression. So of course that might not stick, So I'm not saying it's guaranteed, but the way I do my analysis, I'm very confident that my companies will be returning higher and higher dividend yields, yield on cost later. But let's say you increase it 10% per year. So some examples of companies that have increased it 5% per year, usually very mature companies like tobacco, Altria, Philip Morris, British American Tobacco, utilities. These kind of companies have been increasing at 5% per year for the last 20, 30 years. Some companies increase it by 10% per year though. What are some examples? Well, lately financials have been. You want to be careful of financials because of recessions. Pharmaceuticals, big pharma has been increasing at 10% per year plus. Aerospace and defense has been increasing at 10% per year plus. Companies such as advertising, like Omnicom, they've been increasing at 10% per year plus. Industrials like Cummins or Caterpillar, they've been increasing it for 10% per year plus. So the same $3 per share dividend, if you do 10% growth, you're now making by 2030 dividend growth, you're now making $7.78 on your initial $100 cost. And that's actually a typo there, my apologies. That should actually say 7.78% yield on cost. So imagine getting 10% of your money back, not including what the company's earning in the capital growth, but also in dividends. Well, that's great. I mean, so you start off at a $3 per share, you're going to 4, 5, 6, 7. Now you're at $7. You're getting, if you put in $1,000, you're getting $77 back every year. That's pretty good to me. Here's an example of that, Lockheed Martin. As you can see, Lockheed Martin yield in 2002, as you can see, or you don't even look at the yield, I want you to look at the payout amount per share. In the turn of the century, it was paying out 44 cents per share. Well, if you had just held Lockheed Martin, not only would you have gotten the capital gains, which I don't intend to sell a business, so I wouldn't want you to sell the stock, but look at the payout amount, $10.60 per share. So let's say you paid, I don't know, $100 per share in 2000. You got a or actually you could calculate it exactly. If you got a 2.21% yield on 44 cents, you could actually make that calculation. You would just take 0.44 divided by 0.0221 and get the share price. But I'm going to make it easy. If you have $100 per share and you bought it in 2000 for a 4.4% dividend yield, well, sorry, 0.44% dividend yield, you are now receiving back $10.60. So that 0.44% dividend yield is now yielding you 10.6% on that $100 investment. That's pretty amazing. You're getting over 10% of your cash back year over year. Here's the same thing visualized. over a graph. So as you can see, as you go farther and farther out, your yield on cost gets higher, obviously, because the company share is increasing its dividend every single year. So here's an example. If you had bought Lockheed Martin after 2009, during the Great Recession, you would now be sitting on a 15% yield on cost. So if you put in $100 in the stock, just with your dividends, you're getting $15 back every single year, which is 15% return cash on cash return, not including the company. So I think that's how you have to analyze investments. Here's Altria that I talked about. I'm not going to go through everything because I want to get on with the video, but the same kind of dynamic here. Altria has increased its dividend every single year for the last, I think, 25 years or 50 years or something. I don't know the exact statistic on that, but not as fast as Lockheed Martin because it's in a more mature industry, but it has been increasing its dividends. Once again, look at the yield on cost. If you had bought it in 2008, you're now making a quarter of your investment back every single year in cash. So in 4 years, your initial investment is paid back today. Now, don't forget you've got dividends for the last 12, 13 years on top of it. Plus you've got the share price appreciation. Altria is actually the #1 performing stock in the S&P 500 over the last 50 years. It's just amazing. People think it's Apple or Amazon. It's actually Altria if you reinvest all those dividends. So Amgen is a very new dividend company that I'm also invested in. And of course, now the Amgen has a lower yield because they just started paying a dividend. But even if you bought it, a few years ago, 5 or 6 years ago, let me see, 2014. So yep, you could have bought it in 2014 for a 1.87% dividend yield, which now your yield on cost is 5.64%. So that's pretty good to me. So now I'm going to go into my methodologies for how I choose my investments. And I'm going to now give you an example of Bristol Myers Squibb. So you guys probably remember Bristol Myers Squibb is one of my investments that I started investing in back at $59, and that's my cost average price per share, $59. So as you guys can see right here, I don't know if you can actually see my mouse, but I hope you can. $59 per share, somewhere around here. So right after the collapse, after the COVID-19 situation, lockdowns and all that, I started buying Bristol Myers Squibb at 59. Now, I utilize a software called FastGraphs, and I want to give credit to Chuck Carnival, who created FastGraphs. I don't actually use the software, but I go on YouTube and I like to look at some of his videos. What FastGraphs does is basically the same thing as a fundamentals analyzer software. So it takes the earnings of the company and looks at where the company has traded in relation to its earnings. As you can see, the company has tracked its earnings very well, right? So you see this company started to have some growth here, and remember, the stocks always front run what. So back here, the company was probably started telling its shareholders that, okay, we've just made an acquisition, we're going to start to see some growth. So the share price is already going to start pricing that in. Now keep this in mind. This orange line is a PE of 15. Bristol Myers Squibb has traded a little bit above that. I think this is about 18 or so. Right here, it's 17.83. So what that means is anytime Bristol Myers usually gets above 17.83, it means it's overvalued in relation to where it's traded. Okay, so you have to keep in mind that you don't want to buy the stock when it's up here in relation to what it's actually earning, because it means that you're basically overpaying for a 15 or 17 time earnings where it's always traded. So what happened after COVID, the lockdowns and all that in 2020 is Bristol Myers acquired Celgene. And because of that, its earnings were forecasted to go shooting up. But people were still selling Bristol Myers Squibb as though it had a PE of 9 or 8 or something like that. You can see right now it's at 9.38 in relation to where its earnings are. So what I did is I saw the opportunity back when I started utilizing FastGraphs. And once again, I want to give credit to Chuck Carnival. But I saw that the company was forecasted to grow its earnings incredibly. And at 9 or 8 times earnings, it was incredibly cheap. Obviously, at this time, it was probably about a 12 or something. But I knew that it was incredibly cheap in relation to where its future earnings were going to go. And As you can see back here, earnings were growing at, so you got to think about this logically. If earnings are growing at, okay, 6, 17, 6, negative, negative 9, 2, 9, and now earnings are growing at 41, 6, 32, 18, 37, okay, and it just made a big acquisition. Obviously, Bristol Myers Squibb has to at least trade at the same PE that it did back when earnings were more flat. So I knew that earnings had to recover, the price had to recover back to price to earnings ratio. So I bought in at $59 and I kept buying, up 65 when it went down to 55, 57. And I have a pretty good cost basis now. And as you can see, because earnings are starting to materialize now, and the company is forecasted to grow its earnings once again, continue to grow its earnings, it's starting to get back. And I think I'm a little late right now because obviously, like I said, I'm a little, late because I said that I created this video when a week ago. But actually what has happened is I believe the stock price is now at 77 or 78. This white line right here in fast graphs is basically where Bristol Myers Squibb is paying its dividend. So as you can see, the dividend has been very steady for the last few years, but it really, for me, back when I was buying it at 59, I knew that there was a lot of potential for dividend growth here because of the huge earnings. Okay, so I knew that Bristol Myers Squibb would most probably continue to reward its shareholders by increasing its dividend, and that has materialized. It increased its dividend, I believe, by about 12% since I bought it. 12%. So remember, we were talking about 5 and 10%. This is 12%. And I'm sitting on 20, 25, almost 30% capital gains, which I'm not going to sell because I believe this company is, it's going to realize its true potential. So you have to also use other resources to make sure that the earnings projections are correct. Okay, so I go on fast graphs here and I look at, okay, year end 2022. The earnings projections are 779's earnings per share. Okay, right here, December 2022, it's 763. Okay, so you can see it's beaten its earnings every single time. Okay, so there's a good chance it's a very recession resistant industry. It's in biopharmaceuticals. People don't stop taking their drugs, So as you can see, is beating earnings every time. So it's most probably going to beat it again. Now, here's 751 earnings per share at a PE ratio of 15, and here's 779. So it's very negligible. 763 is probably just under that triangle. Okay, so I now go out one more year. I look at 831 earnings for the year end 2023, 819. Okay, so once again, this is 779, okay, 780, let's say, and this is 831, somewhere in the middle here. So, okay, well, it's not up there, but it's still, this is what I mean by margin of safety. You've got strong earnings for this company, and look at where the stock is trading. It's trading like it's a PE of 9, So how can a stock trade at 9 when it's historically traded at 15 or 17, when there was no growth, and now when there's true growth and continued growth in the future projected, it's going to trade at 9? No way. So that's why I made the bet, and so far I've been succeeding, and I believe we're going to continue to succeed. Not only that, but like I said, Bristol Myers Squibb is a recession-resistant company. It's been increasing its dividend, I believe, for like 18 years now in a row. And as you can see, here's more proof that the acquisition is paying off. As you can see, the dividend growth rate has been increasing dramatically. It's gone from 1.5 to 2 within the last, let's see, I mean, I think this is 2020. Now I can't see it actually. I think this is 2020. Yep, this is increments of 5. So from 2020 to 2022, where we are right now, it has increased its dividend 1.5 to 2. That means it's increased its dividend 33% in 2.5 years. That's incredible. And I want to go back here. I believe that's going to continue. I mean, if it continues to beat analyst estimates, even through 2020, it beat analyst estimates when, and it grew earnings when a lot of companies' earnings cratered. So I know that, okay, this company is recession resistant. I would say personally, I think I might buy more, especially at a 3% dividend yield and 9.3% blended PE. It's probably about a 10 now. I think I'm going to buy more. Now, once again, this is not financial advice. Please make your own decision. But I'm just telling you my strategies. We're trying to grow together. So, and I also want to make sure that the company will continue to pay out its dividend. I mean, I don't just want it to have a good history, I want to make sure that the payout ratio, which is basically how much dividend it's paying out per share over how much earnings it's making per share. Because if you get a company that's making $10 per share and paying out $12, that means it's either going into debt or burning cash to pay its dividend. So I want it to pay its dividend from its free cash flow or its earnings. Okay. And right here, you see earnings per share for the next 12 months is supposed to be $7.63. Remember we looked at that here, projected? Well, the dividend per share is $2.16. So the earnings have got to crater quite a bit for this company to stop paying its dividend. And I think that's not going to happen. Okay. So this is the part where I can really grow with you guys. So I'm really good with analyzing earnings and finding good deals in the market, and finding good dividend growth deals when everybody else is selling certain stocks. Okay. But I'm not good with accounting and analyzing balance sheets. So this is someplace where I'm trying to improve upon. So please bear with me, guys. If there's any CPAs or accountants. As you can see, this company has $15.2 billion of cash and $46 billion of total debt. Now, I believe a lot of this debt was brought on by the Celgene acquisition. As we know, Celgene is the company that's giving this Bristol Myers Squibb a lot of growth acquisition. So I then go down here and I look at operating cash flow. So this means that just for the company to stay afloat and operate, it has $16.2 billion left over. So in 3 years, the company could pay off its total debt just by continuing its operations. I believe that's pretty good. You also look at the free cash flow, levered free cash flow, it's $14.87. So this is how much money the business has left over after, I believe, its operations, debt, interest, so if it's earnings before interest, taxes, depreciation, amortization, I believe after all that, that's the free cash flow. Okay, then the company pays its dividend, and then it's got what's left over. So I believe that with a $15 billion free cash flow, the company is not going to have a big problem paying down its debt. I went on another resource called Simply Wall Street to see what they had to say about the company's debt ratio and everything. And it says here that the low debt to EBITDA ratio of 1.5, which means that the total debt to EBITDA, so if it's earnings before interest, taxes, depreciation, amortization, if the total debt is 46 billion, EBITDA, if the debt to EBITDA is 1.5, that means the EBITDA is 30 billion, which is pretty strong, which means that it's modest use of debt. Okay. And it also says here that the company grew its EBIT, so earnings before interest taxes, by 12% over last year, further increasing its ability to manage debt. And it also says here that it is future earnings more than anything that will determine Bristol Myers Squibb's ability to maintain a healthy balance sheet. So that means that earnings have been growing. Earnings are forecasted to grow. The company has never missed earnings in the last 4 or 5 years, even through the recession. It's increases dividend for the last 18 years or so, 16 to 18 years. It also says here that a conversion of EBIT to free cash flow suggests it can handle its debt easily, as Cristiano Ronaldo could score a goal against an under-14s goalkeeper. It says here, happily for shareholders, Bristol Myers Squibb actually produced more free cash flow than EBIT over the last 3 years. So that means the company produced more money left over after its business operations than earnings before interest taxes, which means that it can pay its interest and its taxes with its free cash flow, which is a very good sign. So I really like that. I think that's a good sign for this company. And another thing I want to talk about is the credit rating for this company. Obviously I was buying this company last year when it was 50, 55, 60, 65, 59. So you're not going to get those prices anymore, obviously, because we're looking back. But like I said, for my own personal self, I'm not telling you to buy it, but for my own personal self, I'm probably going to buy more because the good sign is that, for example, in February 2022, and please keep these dates in mind, Moody's assigned A2 to Bristol Myers Squibb notes. Okay. Now, in 2021, Fitch said that Bristol Myers Squibb was going to be A minus. So if we go over to this table right here and we look at Fitch, we go to A minus back in June 2021, and we know that Bristol Myers Squibb Moody's assigned A2 in February 2022. That means it went from an A minus to an A2. Moody's assigns A2, which means that that's a good sign because the latest credit report has actually in a way upgraded it. If you go by this table, it's actually upgraded Bristol Myers Squibb from an A minus Fitch to an A2 Moody's. Now, obviously there are different companies doing it. We've got to see what Fitch says when they come out with their latest credit rating, but I believe this is a good sign. I believe this is very good. So that was really it, guys. I hope you enjoyed that. Like I said, I'm growing with you guys, through this journey. I've made some good investments in the last 2 years. A lot of my companies are producing positive earnings. So I sleep well at night while this market is collapsing right now because of overhyped stocks. I want to continue to show you guys my moves in this market when people are just kind of randomly buying stock just from name recognition, without any analysis or whatever. I want to show you guys what I'm doing. I want to show you guys how I'm doing it so that you guys can see the fundamental analysis, and you can also tell me if I'm doing something wrong. I want to continue to learn more about balance sheet strength. Like I said, guys, I want to strengthen that. I'm going to be reading some books on that, reading some articles, watching YouTube videos. YouTube is a great place to learn. And in the future, I will talk about overall discussions on macroeconomics and my thoughts on the future market. So I definitely want to do all this. So please stay tuned, guys. I really hope that we can grow together. And if you made it this far, I want to thank you guys for watching this. And yeah, I hope you guys have a great day.